I bought SVOL to make money and I didn't want to have to work for it. That's literally the definition of passive income. If you appreciate the upfront honesty, let me know. The like button is right there. But in the spirit of honesty, I sold SVOL recently because of 3 major findings. Now, let's be very clear. I'm not saying you should sell or buy SVOL. I'm not a financial advisor and this isn't financial advice. But I will share with you what I found and some specific information that might apply to you too, so you can make a decision and understand for yourself where I'm coming from. But with the information I'm presenting to you, you might also better understand where the fund managers are coming from as well. As always, let me know in the comment section what I got right, what I got wrong, and what I missed, so we can all be better informed. Let's get into it. I was first drawn to SVOL because of its unique approach that allowed investors to generate extra income. Just kidding, that was the second thing. It was really the double-digit dividend yield. It uses futures contracts to generate premium. This isn't necessarily a new thing, but the unique aspect of SVOL is that these futures contracts are for the VIX, which is the measure of volatility in the market. As far as I know, no one else is doing this, and this strategy seemed like a great idea for me personally. I like that I could generate passive income from a unique investment outside of the traditional stock market. For once, it was nice to not have to worry about stock prices directly and still get a yield. I'm not an expert on options or futures trading, and I'm not an expert on how the VIX works, so I'm perfectly happy to pay the expense ratio of SVOL if it means I can generate passive income from someone else's expertise and not have to take the time myself to buy and sell the positions. I mean, the managers of the ETFs work hard too. They should get paid for their services. And this is where my first findings come in. When I first looked at SVOL, its expense ratio was 0.66%. I thought it was higher than other ETFs I've seen, but something like SVOL would require more management, so I thought it was worth it given the dividend payouts. The problem is if you look more recently, you'll see that the expense ratio is up to 1.16%. That's almost a 2x in cost, which got me thinking, am I getting 2x my value from when I originally purchased? Spoiler alert, the answer is no. That got me to look into the history of the dividends I was receiving. My second finding is the fact that this year in September and October of 2023, SVOL did not actually pay a full yield. You might have seen it hit your account normally like several months prior, since it paid out roughly the same 30 cents per share, but looking into the finer details, it actually had a return of capital accounting for 83% of the payout twice in a row. That's not exactly ideal. A return of capital is not necessarily a good or bad thing. What an investor should know is that if a return of capital is reinvested, it lowers the cost basis of the investment. However, this can also mean that the investment is not generating income, so the fund has to pay out from cash on hand. And this means you run the risk of losing money overall despite a high dividend yield. This isn't ideal for an income investor or people looking for high yield returns, but also nobody likes losing money. And when return of capital comes into the mix for high yield investments, in my experience, this is usually a bad sign and leads to losses or less dividend yield, probably both. Because I considered SVOL to be a risky investment from the beginning, and after seeing the recent dividend payouts, I was watching for information on November's distribution like a hawk. My thinking was, if there's 3 months in a row that a return of capital event is happening, there is something going on that I didn't sign up for, and I don't want my money at risk. In addition, if the fund managers aren't able to address this issue in this time frame, this obviously isn't a simple fix, and who knows how long this is going to take to get solved. So there I am, stuffed with turkey and mashed potatoes for a few days after Thanksgiving, while also refreshing SVOL's webpage every few hours, as if the fund is going to magically update their website on a holiday weekend several days earlier than they normally would. Like, at some point you just run out of football to watch. Now, SVOL did end up paying investors in November of 2023, and it was not ideal since a return of capital was present again, although this time it accounted for 60% of the distribution. Something changed, obviously, since I was expecting another 80% return of capital for the overall yield if there was going to be one. So the first place I went looking after this data came out was the fund's holding. Now, I'm no options chain expert, but this brings me to finding number 3. It doesn't take much to see that SVOL has had a significant change in its holdings. Looking at the updated listing from when I bought SVOL, it looks like they added a bond position inflation, among a few other things. So now in addition to the other risks that SVOL has, the holdings are now subject to overall interest rates. Hello, Mr. Powell. Now this isn't necessarily a terrible move, as it seems like the Fed may be done raising rates, but no one knows the future, and might be a reason for why the dividend in November had less return on capital than October and September. Maybe the fund used some of the yield generated from the holdings and distributed that as yield. That's total speculation, of course, and I did not look at the options chain, so it could very well be that because of the premiums from those trades. Either way, 3 consecutive months of return of capital was a problem for me. So given all of the new info, I want to remind everyone that SVOL trades futures contracts on the VIX, and if you look at the VIX historically, it does seem to eventually spike. Well, SVOL has never existed during a spike, so its performance during a period like this is totally unknown. Fortunately, the fund managers also know this, and they buy positions as insurance for these spikes, although it will remain to be seen if the fund has enough coverage in place, because nobody knows how large of a spike there will be. So again, I consider this a risky investment, and I knew this risk was present going in several months ago. So originally, I was comfortable with the lack of history, given that the fund has a strategy in place to protect against these volatility spikes. But given all the other changes that's been going on with the fund, this isn't the ETF for me. There's simply too many unknowns and too much return of capital for me to feel comfortable holding this ETF at the moment. Now here's the thing though, even if these findings were not present, I probably still would have sold SVOL, although I likely would have held on for a good while longer. This investment is a specific product for a specific kind of investor, but my main concern for me personally is opportunity cost as someone who has a long-term horizon. Is there a better investment for me available? Probably. SVOL does not state that it has any plans to try and achieve growth. That's not what it's designed to do, and not why I bought it initially. I was here for the yield and the strategy used to get it. Now, it's true that an investor could reinvest the dividends to allow for compound interest to snowball into a larger position, but ultimately, if you have a long-term horizon and believe that the markets are going to trend up in the future, from an overall gains perspective, you might be better off buying something else that can appreciate as well as give off a yield with less risk. So for me personally, I'm thankful that SVOL did end up figuring out how to get investors a distribution in November, although a majority of it was still a return of capital. I'm thankful that SVOL hasn't lost me any money from my former position overall, and paid a dividend for most of the entire time that I owned it. But for me, with my long-term outlook and given the risks and recent changes, I decided to sell and take risk off the table. Maybe next Thanksgiving will be a little less frantic for me. If you're in SVOL because you're looking for income and need it today for your expenses, this is the information I wanted to present so you can make the best decision possible for you as an individual. And I want to be perfectly clear, I don't think SVOL is a bad investment or poorly managed at all. I think it's way too early to make that kind of claim. It's clear that someone in charge of this fund with over $500 million in it is looking at this data and adjusting, which is exactly what you want a fund manager to do. If things aren't working, switch strategies to something that does work. They might just need a little more time to get back on track and wait for market conditions to be more favorable to generate a yield for investors. I don't know if that will happen, but I am hoping it does. It's just not right for me at this moment in the short term, given what's happening in the overall markets, how the fund has been performing, and who I am and my timeline as an investor. Once more data becomes available on SVOL, I might be more comfortable putting my investment money into it in the medium and even maybe long term as well. So this ETF is still on my radar. As far as what I'm going to invest in next with the capital I got from selling my SVOL position, I haven't quite figured that out yet. It seems like every other day a new income-seeking ETF is available, and I'll continue to be doing more research into them as I find them. So when I figure it out, I'll be sure to let you know. So go ahead and click that like button if you found value in the video, of course. Let me know your thoughts in the comments section. Click the subscribe button for more content, and I'll see you in the next video. Thanks for watching, have a good one, and of course, good luck in the markets.